All right. Many thanks to the organizers for having our paper on the program. This is a fantastic venue, and I absolutely love this conference, and for encouraging me, I guess, to try skiing. So this is joint work with Songrun. He was a finance PhD student at WashU. Omri Ross is a comp sci professor at Copenhagen, and Victor von Wachter, who was his student at the time. We wrote this paper. I'm Asaf Manela. You can also call me Master of the Chickadee from today. Perpetual futures are swaps that never expire. And they're an efficient way to hedge and to speculate on any asset. They allow high leverage. There's no need to take delivery of crypto, for example, if you use perpetual futures as opposed to just buying cryptocurrency directly. There's no rollover, which is a really interesting feature of perpetual future that sort of makes you wonder why this hasn't been applied yet to traditional commodity markets. And they allow for a concentration of liquidity in one security as opposed to spreading it all over a whole term structure. So I'm going to explain how these work in much more detail. But these instruments have been suggested a long time ago, in fact, by Schiller in 1993. He was trying to fix the housing market and allow investors to hedge away some of that risk. Never took off in 1993. Not until the crypto bros, the crypto enthusiasts picked the idea up in 2016. So we've been fascinated by these, and we thought a lot about them, so I'm very happy to share. So one of the reasons we were interested in them is that these are by far the most traded derivative in crypto markets. We estimate quite conservatively that there's about $100 billion traded daily in perpetual futures. This is not quite yet $5 trillion as in traditional currency markets, but it's getting there. It's pretty large. These were among the most actively traded derivatives on FTX just before it blew up. With Alameda Research, the hedge fund that made Sam Bankman-Fried who he was, a counterparty to many such leveraged trades. So you can see how that spread kind of blows up just before FTX explodes itself. So what we're going to try and do in this paper are two things. We're going to ask, what are the fundamental values or the NOR prices for these perpetual futures in theory? And second, empirically, how large are deviations from that benchmark? Okay. Our theoretic contribution is to derive no arbitrage prices for perpetual futures in frictionless markets. And we're kind of shocked that this didn't exist before this paper, or at least not to our satisfaction. So we're going to provide such a benchmark. And second, we're going to provide no arbitrage bounds for markets where there are some frictions, like trading costs. On the empirical side, we're going to document that deviations of crypto perpetual futures from these no arbitrage benchmarks are quite large, so much larger than what you have seen maybe in Adrian's work on traditional currency markets. We see that the deviations move considerably across cryptocurrencies, suggesting that there's some common friction that's moving all of these deviations. And we see that these deviations diminish over time as perpetual futures market and crypto markets in general become more efficient and more sophisticated. The last point, there were a couple of these questions for the papers early in the morning session. So we're going to show you a strategy that tries to exploit these deviations. I think that exercise is mostly helpful to understand the economics of it. How large is this really in practice? All right. So putting this paper in context, there's a growing literature on perpetual futures, mostly early on by practitioners. Later on, academics took this up. I think this Kristen paper probably did this in the best way in their empirical exercise. What we do is we provide the first no arbitrage prices for perpetual futures. And the fact that we have this benchmark means that we can calculate deviations going both ways. And whereas what previous work has done is just said, okay, suppose that we just institute a carry trade and we always go short the future and long the spot. How profitable would that be? All right, so I'm going to go through this rather quick because there's a lot of experts in this room. But I think it's worthwhile to go through how arbitrage works in fixed maturity futures so that I can contrast it with a perpetual futures derivative. So in a fixed maturity futures, there are two counterparties that are created times zero on a price at which they will exchange assets at some future expiration date tau. Okay, so fixed maturity future, you know that this will happen at time tau. Now, at the expiration of this contract, the short counterparty is going to deliver to the long counterparty the underlying in exchange for the future price. Okay, now this is highly simplified, but it still does the trick here. Now, in the absence of arbitrage, the futures price, F, only depends on the initial underlying price, S, and the interest rate. The amount of the interest that they have to pay to borrow cash in this market. And this is a well-known result, right? The futures price is just the future value of the spot price. Very simple. I think everybody probably knows this. This equation easily extends to dividend-paying assets, storage costs, all these other complications. But I want to go through why is this the no arbitrage price? So this is no arbitrage price because suppose there was a deviation. Suppose that the futures price was actually larger than that price. Well, if it was larger, then an arbitrageur today would open a short futures position, They would borrow dollars in cash markets, and they would buy the underlying spot to cover. So zero cash flow today. And at expiration time, they would collect the futures price, deliver the underlying asset, and repay the dollar loan. So these are the cash flow implications of it. And if you just add it up, you get the positive net cash flows at the expiration, which tell you that, that this was actually an arbitrage opportunity, right? So money for nothing and some profit in the future. Now, let me contrast that with perpetual futures. So in a perpetual future, there is no expiration date. Right? There's going to be no initial cash here. They can be open at any time. All that you need to find is a counterparty. So if I want to go short in the perpetual futures market, I need to find somebody else who's willing to take the other position for that same price. At termination, the short is going to pay the long the difference between the new futures price and the old one. This is in reality mark to market continuously, or relatively high frequency. Now, everything that I just described doesn't anchor in any way the futures price to the spot price. There's nothing here that guarantees that the futures price converges to the spot price at any point in the future. So what the designers of these markets said was we're going to have a funding rate mechanism. Okay? Periodically, this happens every 8 hours on Binance. The party that is long is going to pay the party that is short a payment that depends on the spread between the futures price and the spot price, okay? Multiplied by some coefficient. And in our case, that coefficient is about 1,095. How is this helpful? Well, if you think about it, what you want as a designer of the market, you want the futures price to be very close to the spot price. Otherwise, this is not a good hedge. So if the futures price opens a gap relative to the spot price, you want to encourage arbitrageurs to long the spot and short the future. Well, if this payment is large and is increasing with that gap, that means I want, as an arbitrageur, I want to short more of the future and long more of the spot, which is going to encourage convergence between the two prices. Right? And the same the other way, same story the other way. All right, now note that arbitrage here is risky. there is nothing that guarantees, again, that the futures price converges to the spot. So to make progress here, we're going to think about a weaker definition of arbitrage than this textbook, right? So the textbook definition of arbitrage is that there's some point in time when you know that your strategy or your opportunity will generate a positive profit almost surely, at least in some state, and you're paying nothing for it, or maybe even negative amounts today. Right? That thing at the top here, that's the traditional definition of arbitrage. What we're going to define is a random maturity arbitrage. And a random maturity arbitrage opportunity is basically the same idea, the same thing. It's just that you don't really know what will be the unwinding time. The unwinding time is random. But you know that there will be some future unwinding time at which you will generate a positive payoff from this strategy. That's the key. Now, there might be some people moving uncomfortably in their chair now. Okay, this is not an arbitrage opportunity, right? And I think that's true. But I also think that no arbitrage prices are always just a useful fiction. Okay? Real markets have barriers to arbitrage. They have they have frictions, they have borrowing costs, they have margin requirements, all these things that prevent arbitrage from happening. And so I'm going to think about random maturity no-arb prices as just another useful benchmark. Now, is it a useful benchmark in practice? That's the empirical part of this paper. I'm going to argue that it is. But this is what, when I say no arbitrage prices for perpetual futures, this is what I mean, under this random maturity arbitrage. All right, so this is what that weaker assumption of arbitrage buys me. All right, I'm going to make two assumptions. The first is that the perpetual futures to spot gap, it's kind of technical, but what this assumption really means is that that future to spot gap can temporarily explode. It can become very, very large for a while, but at some point in the future, it has to converge to some bounded gap. Right? That's what assumption one is. I think it's pretty weak. The second assumption says that the risk-free rate that arbitrageurs have to pay to borrow cash in this market is constant. Right? So under these two assumptions, we show in the paper that the absence of random maturity arbitrage implies that the futures price takes a very simple and intuitive form relative to the spot price. What does this say? This, to remind you, this is the interest rate that the arbitrageur has to pay for borrowing cash in this market. Kappa, maybe you forgot, kappa is this coefficient that multiplies the funding rate payments, right? It's this coefficient right here. And what this expression says is that the perpetual futures to spot gap is going to be small if interest rates are small, or in particular small relative to the funding rate coefficient kappa, right? So the interest rate prevents arbitrage, or this encourages arbitrage. The funding rate encourages arbitrage. So that's why you have this tension. It does not show up in fixed maturity futures. All right. So how do we come up with this result? We says, well, similarly, suppose that the futures price is actually higher than our fundamental value, what we think is the fundamental value. Well, an arbitrageur would, similarly to what we had before, they would open a short futures position. They would borrow dollars in cash markets and buy the underlying asset. Zero cash flow today. Now, at a random, so I emphasize random unwinding time, T, they would close the futures position. They would sell the underlying at the spot price. They would repay the dollar loan. Everything here so far kind of the same as before, but now they also accrue funding payments, right? This whole sum here are funding payments that they accrue from time 0 until time T. And if you add all this up, you get this net discounted payoff that's here at the bottom. All right. Now, so how do I know that this is positive? So I usually don't go through proofs, but I think that this proof gives some of the intuition for what happens in this market, what is the tension for where we get this result. So I'm going to try and go through this. So the proof goes by contradiction. Right? So suppose this is not a random maturity arbitrage opportunity. Right? Remember, I started with this deviation. The futures price is bigger than that. And suppose this is not a random maturity arbitrage. That means that for all t in the future, all of them, the payoff is non-positive from the arbitrageur's perspective. Now, that means that the benefits, roughly, or the cash that the arbitrageur gets is smaller than the losses that they can sustain from the fact that the futures to spot rate actually widens on them, right? So on the right-hand side, you have this spread at unwinding time, which is what they worry about really as an arbitrageur. On the left-hand side, you have the traditional spread, right? This is the only thing that's going to survive in a traditional fixed maturity security, plus the funding payments. So if these are large enough, this actually will be an arbitrage opportunity. So the way we make progress here is that it turns out we can bound this process, the stuff on the left-hand side here from below, with this expression right here. Well, how is this progress? Well, if you look at this and think about what happens when t grows large, well, this term here is going to go to 0. That's fine. But this term here can potentially explode. Well, if it explodes, that means that there's no way that it is actually smaller than this term here on the right. That's exactly where we get our no arbitrage price. Right? So if the futures price is actually, this was my maintained assumption, the futures price is actually bigger than the fundamental value that we propose, that would violate our first assumption about the bounded spread. And we actually find a random maturity arbitrage. All right, so that's how this proof kind of goes. All right, so that was our main result, or our first result. The second theoretical result generalizes this to potential transactions costs. So this probably wouldn't shock any of you. If you have transactions costs, there's a bound around that fundamental value where the futures and can be relative to the spot. All right. What's nice about this expression is it's not just an arbitrage bound. This is also a recipe for arbitraging away big gaps. Right? It tells you that whenever the gap is bigger than that fee or that transactions cost that you will bear as an arbitrageur, you want to enter this arbitrage opportunity. All right, so far for theory. Let me show you how this looks in the data. So we're going to focus on the 5 largest cryptocurrencies with a total market cap of about $500 billion. This is 64% of the crypto market as of November 2022. We're getting all of our data from Binance, which is the largest crypto exchange by volume. And more than that, Binance allows us to look at the entire trade on one platform. Whereas if you look at other platforms, you'd have to do some stuff while moving. So that doesn't really work. All right, so we're going to define the deviations in intuitive units by thinking about the deviation rho as essentially how higher would interest rates have to be for this equation to hold with equality. Okay, so it has units of annualized interest rates. Okay, so this is what rho, those deviations look like in the data. So we find that the mean deviation is no different from 0. I say that because all of these p-values here cannot reject the null that these are 0 on average. In that sense, this is a fairly useful benchmark for perpetual futures. All right? This is the fact that the p-values are not different, cannot reject 0 is not true for the absolute mean deviation. So the mean absolute deviation is actually quite large. So think 60 to 100% annualized. All right? These are really, really large. And in fact, much larger than the deviations that Dutepper and Verdelon find in traditional currency markets. This is what those deviations look like over time for the 5 cryptocurrencies that we study. I can't see that. It's 10 minutes. Thank you. the first thing that pops at you when you look at this figure is that there's a lot of co-movement. There's very strong co-movement across cryptocurrencies in these deviations, suggesting that it's probably the same intermediaries that are arbitraging all of these, or at least they face the same market frictions or changes in the market frictions that prevent them from arbitrage activity here. And the second thing that jumps at you from this figure is that the deviations shrink over time as these markets become more mature, more efficient. All right, so as I mentioned, the no arbitrage strategy that we have prescribes a threshold strategy to exploit deviations from no arbitrage. So if you face no fees, and so if you're a market maker, if you're Jane Street trading on Binance, you're going to face essentially no fees trading there. You want to be in the market all the time. Like, whenever there's a deviation, you want to arbitrage it away. But if you face higher transactions costs, and we're going to look at these 4 tiers from Binance, you may only want to enter the market when the deviation is about 180%. Right? So you should think about, again, the no-fee tier as a high-frequency shop. You want to think about the high trading cost tier as Asaf in his home creating a bot to trade this. All right? That's roughly where that would be. So the strategy that we're going to think about waits for the deviation to exceed their transactions cost. And if the deviation is positive, they're going to borrow cash, buy the spot, and short the future, and wait until the deviations goes back to 0. Okay, this is our strategy. Now, Avner told me, this may not be the optimal strategy, and I think he's right. But this is simple enough for our purposes and transparent enough for our purposes. I don't want to solve, a whole optimization problem to get there. All right, so this is what that strategy would look like for the highest trading costs tier who would trade perpetual futures with an underlying of Bitcoin. Right? So this is the most liquid cryptocurrency. And you can see that early on in the sample, they would be in the market quite a bit. So every time the deviation exceeds this yellow line, they go and short the future and long the spot and wait for that deviation to go back to 0. So very active early on in the sample. Late in the sample, you can see that the spread shrinks considerably for Bitcoin. And this is within sort of the high trading cost bound. All right, so let me show you some numbers. So how big is the performance of this strategy? Now, there's a lot of numbers here. I want you to focus on this first line first. And I'm showing here the Sharpe ratios, the annualized Sharpe ratios for investors with different fee tiers who are pursuing this random maturity arbitrage strategy for Bitcoin. And you can see that the Sharpe ratios that they would generate range from 1.9 for the high trading cost arbitrageur to about 4 for the high-frequency trading shop. All right, so this is Bitcoin, the most liquid, most actively traded crypto derivative. This is what those Sharpe ratios look like for the other 4 cryptocurrencies that we study. So they range between 5 for Ethereum and 12 for this is the Binance coin, the Doge coin, and Cardano. So these are quite large, I believe. Now, this is a random maturity arbitrage strategy, right? There's no date at which you're going to unwind this. So we thought it'd be interesting to try and quantify how long would you actually need to be in this market from when you open to when you close this position. And what we're reporting here at this OTC time is the time in hours from when you enter the position until you unwind it at the profit. You can see that for the high-frequency trading shop that pays no fees, that would be about 16 hours until they unwind the position, whereas for Asaf trading with his bot, that would be like 113, right? So a bit longer. The performance of this strategy, as you can already kind of see from the figure, which shows that this market is becoming more efficient over time, used to be better, right? Thank you. So it was, the Sharpe ratio for Bitcoin was about 2.26 in 2020. It shrinks to about 1.2 in 2022. Not terrible, but not as good. And the second thing I wanted you to take away from this figure is that even if you only pursue the long side of the strategy, right? So maybe shorting Bitcoin is expensive. If you only do the arbitrage when the strategy says you should long the spot and short the future, you can still make reasonably nice performance gains. All right. All right. So for perpetual futures, the gains from this strategy can come from potentially two sources. The first is price convergence. Right, so if you saw a positive gap, you entered the arbitrage strategy, and the futures to spot gap closed, that's money that you've made. But the gains can also come even if that spread remains constant, if the funding rate payments accrue over time. So we thought it'd be interesting to ask whether the gains from this strategy are coming from one or another. And it turns out that most of the gains come from price convergence, as opposed to that futures to spot, as opposed to the funding rate payment, although those are a substantial contributor to the strategy as well. All right. The last thing we do in the paper is we're trying to understand at what times are these deviations larger or smaller, and we find that the deviations are generally larger in bull markets for these cryptocurrencies. So times when Bitcoin, Ethereum tend to go up, and you see momentum in these markets, are also times when the deviations open up. We were kind of surprised, but we don't see a strong relationship with the volatility of the spot prices in these markets. All right. So here's what I wanted you to take away from this. At least this is what we took away from this exercise is we now have what we think are the first reasonable prices for perpetual futures and an arbitrage bounds for perpetual futures. All right. We called this paper Fundamentals of Perpetual Futures because we think that providing such a benchmark is an important first step. These benchmarks don't just provide, some anchor to these markets, but they also provide a strategy or prescribe a strategy that you would use if you wanted to exploit deviations from arbitrage here. And then empirically, we document that there are very large deviations of crypto perpetual futures from these fundamental prices, although again, the average deviation is 0. But interestingly, we see that these deviations move considerably across cryptocurrencies and that they diminish over time as these markets become more efficient. Last thing, I showed you that there's a fairly simple and transparent trading strategy that generates large performance gains from trading these. All right, thank you. That's it.